Nvidia sells you the chips, then it helps you borrow the money to buy them. Then it takes an equity stake in your company, and if you default, Nvidia covers up to a quarter of the lender's loss by taking the chips back. 6 of the largest asset managers, Apollo, Blackstone, BlackRock, Brookfield, KKR, and Goldman Sachs, just signed up to move $500 billion through that arrangement. Now, you might say that this is just institutional money validating the AI build-out, and to some degree, that's true. But $500 billion is actually betting on something very specific: the idea that rapidly aging Nvidia chips can function as collateral. And if that assumption doesn't hold, the whole thing starts looking very, very Ponzi-like. Money stacked on collateral that's melting faster than the debt. So today, we break down the deal that Nvidia signed, why the collateral sitting behind $500 billion of lending is far from robust, and who is left holding the loss if things go sour. My name is Nick, and this is the Finance Bureau. Okay, let's start with the paperwork of this deal, because the devil really is in the detail. What was signed on the 10th of August were memoranda of understanding with 6 firms, with Goldman Sachs acting as a lead bookrunner. The stated target is around $500 billion of third-party institutional capital. That's credit funds, private investment vehicles, insurance capital, all aimed at financing AI compute infrastructure. Now, to be clear, these are umbrella targets, not committed capital, and each of those 6 institutions keeps full independent discretion over the underwriting and project selection. So no capital has been drawn just yet. Also, Nvidia does not lend anything out in this particular system. It doesn't originate the loans, and it isn't putting the principal at risk. It's standing in the middle, introducing the people who make the chips to the people who own the world's pension money. Jensen Huang went on CNBC and said that for the first time, technology chips have become, quote, an investable asset class, revenue-generating, long-lived, fungible, redeployable. And if that's true, this is just infrastructure finance doing what infrastructure finance does. But let's look at what Nvidia is actually promising, because this is the critical part that makes the whole thing work. The idea is called residual value support, which is just a guarantee about what the hardware will be worth at the end of the contract. A lender writes a facility against a cluster of GPUs. If when that facility terminates, the chips are worth less than the model assumed because they're obsolete or oversupplied or the borrower has already collapsed, Nvidia covers part of the shortfall. The reported cap is up to 25% of an individual facility, assessed case by case. And that could be up to $125 billion of potential Nvidia exposure based on this deal. But let's leave the numbers aside for a second and just focus on the actual structure itself. The lender takes the credit risk. Nvidia takes the obsolescence risk on its own product. And the guarantee is not a minor detail of this deal. The guarantee is the deal, because without it, the collateral isn't financeable at all. Which brings us to who's on the other side of these facilities, because the borrowers are not strangers to Nvidia. Take Coreweave. Nvidia reportedly holds around 13% of the company after a $2 billion injection in January 2026, nearly doubling its prior 7% stake. It also has a master services agreement reported at $6.3 billion, under which Nvidia agrees to absorb Coreweave's unsold capacity through April 2032. So, Nvidia is a shareholder in Coreweave, a supplier to Coreweave, and a buyer of last resort for Coreweave's spare compute. Lambda secured a $1 billion syndicated senior secured facility in May 2026. Structured against GPU collateral under a framework built with Nvidia support. And there are also reports of an SPV financing xAI's Grok cluster with $3.5 billion of debt from Apollo alongside a $1.9 billion equity injection from Nvidia funding $5.9 billion of GB200s. Nvidia also holds a position in Safe Superintelligence at a $32 billion valuation, a company that has, to date, shipped no products and published no research results. Equity goes out, compute commitments go back in. Billy Liang at Global X said the guarantees are a strong demand signal, but also evidence that the financing burden in the AI infrastructure build-out is growing. So in essence, this kind of arrangement can make demand appear organic when part of it is actually financially engineered. And that also means the demand signal and the financing signal are being generated by the same company. More than that, what really has people worried is that the asset at the heart of this arrangement is not an asset you can typically lend against for a decade. The lenders are putting up between 50 and 70% of the value of these GPU clusters. For established H100s, they'll lend around 65 to 70%. For newer Blackwell B200s, it's closer to 60 to 65%. The newest, most powerful hardware is trusted less by the people lending against it, not more. Meanwhile, spot rental rates have collapsed. H100 on-demand pricing peaked somewhere around $8 to $10 an hour in mid-2023 and early 2024, and by mid-2026 sits closer to $1.80 to $3.50. with budget providers going under $1. Secondary hardware values also tell the same story. Used H100s that changed hands near $30,000 to $40,000 at the peak now trade somewhere in the $8,000 to $22,000 range, depending on whose appraisal methodology you use. And that spread between the appraisers tells you everything, because these are the numbers the loan books are built on. One early GPU deal reportedly assumed the chips would still be worth at least $15,000, and when they were actually valued for a fire sale, the number was closer to $8,000. On paper, these GPUs lose their value over 4 to 6 years. In reality, with Hopper giving way to Blackwell and then Rubin, they may only stay economically competitive for 2 to 3 years. Some estimates suggest these GPUs could lose 30 to 40% of their value in the first year, pushing these structures into negative equity within just 12 to 13 months. Nigel Green at De Vere said what Nvidia has done is elegant, but that's exactly what worries him, because chips have never been treated as a bankable, long-duration asset before. They depreciate fast and lose value when a newer generation arrives. But remember Nvidia's guarantee? It only really gets tested when those GPUs have collapsed in value. But that's probably the exact same moment Nvidia's own business is under pressure. So this is a promise that becomes most expensive when Nvidia can least afford it. And that's about as fragile as a structure as you can imagine. Now, untangling the mess of circular financing and overlapping structures is a headache, which is why we've decided to make it easier for you. To cut through the noise and get the details that actually matter, all you need to do is sign up for the Finance Bureau newsletter. It's completely free, and we cover everything happening in markets that can easily move your portfolio. Just click the link in the description or scan this QR code on the left of your screen to get started. Back to this question of collateral. We've gone through the reasons why this structure is delicate, but it's worth considering the other side of this argument. The defense goes like this. Lenders here aren't really underwriting the scrap value of the silicon. Instead, they're underwriting the counterparty on the other end of that contract. If a facility has a multi-year contract with a large, financially strong customer, the lenders still get paid, even if GPU rental prices get cut in half. And the numbers do support this. Coreweave has one facility backed by its Meta contract that Moody's rates A3, meaning investment grade. The debt costs roughly 5.9%. Coreweave also says it has around $129 billion of contracted business already lined up, and it beat expectations on both revenue and earnings in Q2 of 2026. Jensen Huang has also said many a time that older chips don't necessarily become useless immediately, pointing out that A100s can remain productive for at least a decade. All very reasonable points, but let's have a closer look at what the market is actually charging, because the pricing and the market participants gives it away. When a company like Meta is locked in as a customer, lenders are willing to lend at relatively cheap rates. Without a giant customer like that, the cost of borrowing jumps sharply. And for the riskiest parts of these deals, investors are demanding returns as high as 14 to 17%. In other words, lenders aren't really betting on the chips. They're betting on the company that has promised to keep paying for them. And even then, there's a problem. Coreweave's customer contracts last around 3 years on average, while some of its debt lasts 5. So the customer can disappear before the loan has even been paid back. But then, where does that risk actually end up? Well, back in late July this year, the SEC issued new guidance saying that many data center financing deals don't actually count as traditional asset-backed securities under US law. The reason is that the SEC sees these more like operating businesses than pools of financial assets. And you know what that means? That means that they sit outside the post-2008 risk retention rules. Most importantly, the company putting the deal together does not have to keep 5% of the risk itself. It can bundle up the debt, sell the entire thing to investors, and just walk away. And those institutions are typically big institutions like insurers, pension funds, and private credit firms. The Bank of England used its July 2026 financial stability report to warn that the pace of that investment is unprecedented historically, and said that pension funds and structured vehicles now hold AI exposure several steps removed from the underlying tech firms. Governor Andrew Bailey warned that a broad AI correction could knock as much as 2.2% off UK GDP. The BIS and the Financial Stability Board have said much the same thing, noting that risk is migrating out of transparent banks and into the private credit industry of roughly $2.2 trillion, around a fifth of which now touches AI or data centers. Michael Burry has, unsurprisingly, been very critical about all of this. He said the latest $500 billion deal is a Wall Street stunt that funnels risk through private credit and asset-backed debt. But what makes this really bad is that, despite AI being new tech, we've actually been here before. In the late 1990s, Lucent Technologies extended $8.4 billion of vendor financing to telecom startups that could not otherwise afford its equipment. That was roughly 24% of annual revenue. The customers bought the kit, the revenue was booked, and the growth looked spectacular. And then the carriers stopped paying. Roughly $7.5 billion of write-offs followed across the following fiscal years. Lucent's market capitalization went from about $258 billion at the peak to somewhere near $20 billion, and the company eventually sold itself to Alcatel. Lucent's exposure was 24% of 1 year's revenue. Nvidia's arrangement, if fully drawn, contemplates a residual value book measured in the hundreds of billions. The defenders will tell you the crucial difference is that money is now coming from independent Wall Street firms rather than the vendor itself, and they're right about that. Nvidia's answer to the risks of vendor financing was essentially just to make the whole system much bigger and shift much of the potential losses onto pension funds and other institutional investors. But the market has started marking this. Coreweave carries $51 billion of total debt against $2.5 billion of trailing EBITDA. That's 20 times. Quarterly interest expense went from $267 million to $640 million in only 4 quarters. Last year's net income was minus $626 million. The stock is down 27% over 12 months. Oracle sits on $156 billion of debt and is down 39% over the same period. And in late July, before any of this was announced, Nvidia's 5-year credit default swaps doubled from around 40 basis points to a record 82. Coreweave's hit around 855 basis points on the 29th of July, which implies a market-priced 5-year probability of default at 50%. Revenue is up 85% year on year. Customers are still paying on time. But inventory is up 127%, and that's the number that stands out. But the funniest part, guys, is that Nvidia is up 22% over the past year, while many of the companies borrowing heavily to buy its chips are down. Now, if you're thinking that all of this just looks and sounds bizarre, you're not alone. But every business involved is behaving rationally on their own terms. Huang has called the circular financing criticism preposterous, and he may be right that the chips are productive assets that generate real cash. But the system being built on top of them expects you to believe that depreciating hardware can act as robust long-term collateral, and that Nvidia's guarantee will hold up when Nvidia itself is under the most pressure. And that belief is now being sold to your pension fund. Maybe it all works out, but if it doesn't, the market reckoning will be nothing short of cataclysmic. Well, on a cheery note, that's all we have time for today, guys. But what do you think? Is this $500 billion deal perfectly justifiable? Or is it the deal that will end up turning Nvidia's problem into everyone else's? Let me know your thoughts in the comments down below. And if you want to learn about how OpenAI is not to be outdone in this game of AI and debt, then you can check out our video on that right over here. As always, thank you very much for watching, and I'll see you in the next video. This is Nick, signing off.